Okay, good morning everybody, this is John, and welcome to the free video, and it is Friday morning, February 6th. So I want to go through some earnings plays. So I've got 5 earnings trades that are all taking heat. Of course, it's all small size and acceptable risk, so no blow-ups. And I'll show you how I structured these. But the main goal was that I sold iron flies, meaning that I sold the strikes where we closed, okay, and then bought protection. So what the red line is, that's the expected move. And then the yellow line is the option where I actually bought protection in the event that we blew through this. And the idea is that, of course, if it opens flat and stays within here, I make a bunch of money as implied volatility collapses. And then if we go through, and I think most of these trades are you're risking 1 to make 2 or 1 to make 3. Okay, so Yelp is going to open up below the expected move. And GoPro is going to open up right at about the expected move. Now, the good news is for stocks that open up down like this is that they actually have a fairly decent chance of rallying. Okay, not obviously all the way back, but just kind of working their way higher, especially something volatile like GoPro. So what is the strategy with the stuff that's opening lower? And in fact, the other one that actually opened up lower is Expedia. And let's bring this sucker over too. So on Expedia, I sold the strikes here at the closing price. This is the expected move, and then this is the option I bought for protection to limit my risk. And you can see we've got the same situation there. So let's look at these 3 first, because these are to the downside, and then I got 2 others that are at the upside, so it's going to keep me busy this morning. And by the way, right now it's 8:11 in the morning, so the market has not opened yet. I'm just going to show you how I prep for events like this. All right, let's start off with Expedia. So if we look at what's going on here, so here's the key is some of the orders we want to place before the open, so we're not completely frazzled. So we're going to open up low, right? So the call, this 88.5 call will essentially expire worthless at the open, which is great. You know, that's going to be money in our pocket. But of course, the 88 put, which is, you know, $2.70 at 80, that's going to jump up to $8, right? So that's going to be a loss that's greater than that. But then it'll be limited. The loss will be limited because obviously this will increase in value, right? So it's all kind of tied together there. So what I want to do is, in case, and because I've got 5 of these things going on, is that in case this thing does drop and then rally like a banshee, I can take some protective measures here. And the most obvious protective measure is that 88.5 call. I can just put in an order to buy that back at a nickel. So if I can find it, the 88.5 call. So there we go. And that's gonna, I'm just doing it as a nickel because that's a price that you can typically get out at. And it's free trade. And that should actually just fill right at the open. Okay. So now, so that order is working. The 94, now you might ask, okay, why not do the same to the $94 call? Well, that's a long option. It's going to be worthless, and there's no point in spending commissions to do it because it's just going to be worth 0. And if for some freak reason Expedia rallies and blows through 94, which is very unlikely, but it has happened, that's a lotto ticket. Okay, so there's no risk in leaving that on. There's a ton of risk leaving the short side on. Now, for the downside, I'm just going to have to wait. I've got to wait and see how things settle in there. So this is the easy first trade. So for GoPro, then the same thing, where I'm just going to come in and say, okay, the $54 call is $3.23. Obviously, let's see, the 54 put, you know, the 48 put, and all that stuff. So the same thing here. I just want to buy back the call. And those will be worthless, so 0.05. Hit enter. And it's good to go. So that order is working. And then the other one, of course, was Yelp. And for Yelp, same thing. I want to buy that back for a nickel. .05. and we're good to go there. Now, I'm going to have to look at some finagling, of course, if I want to try to. Right now, I mean, these trades are going to be losses. The win would come is that if we can rally and then my sold put starts to lose value. So the other thing I could do here, and this would be a little trickier, but I'm looking at doing it, is at the open, okay, at the open, these, because essentially when a stock gaps down like that, you're essentially looking for it to go flat to up, okay? And the idea with this is because of all the short covering from people that are making money on it, they can drive the price up. So guess what? These long puts at the open are going to be worth some money, like $3 or something like that. And at the initial open, there's going to be kind of an explosion, a price explosion here. One of the things that I can do here is actually sell this into that frenzy, get my $3 or whatever. But the downside is then suddenly I'm going to have naked 57.5 puts. The gamble that I'd be making, though, is that while this would kind of explode in value, that since these are in the money and would be all premium, since these are in the money, they're not going to have a lot of premium. They're just going to reflect the actual price, and there's not as much volatility there. And then, of course, if we start to rally, we make the money back. So it's risky, and the only reason I'm willing to do it is because this is a small position size, but that's what I'm going to be looking at doing. And what I'm going to have to do is I'll have to set up 4 of these windows like this and just be ready to go. Because initially I'm not going to know, what the price is. Okay, so now let's look at Twitter and LinkedIn. So these are also putting hair on my chest, but to the other side. Now, this is a little different. Typically, if you rally, so again, here's the sold strikes. And if we rally through, this is the expected move, and then this is the protection. And if you rally through, if you fall through it, typically you're going to trade sideways and possibly start grinding higher. Okay, that's typically what will happen. If you go up through it, you typically will actually go sideways and start grinding higher. So in both instances, you look at going sideways and grinding higher. Okay, I know it's kind of odd, but typically with earnings, the negative news is kind of priced in at the open and it's done. And then short covering puts in a base there. But here, you're going to have short covering and new buying. And then Twitter is right at the expected move. So these are going to be a little bit different. There's an expectation here that A, we could keep going higher, and then B, if we're right at the expected move, we could certainly come back. Okay, so what I want to do here is the first step, of course, is to do exactly what I did at the other one's just the reverse. I'm just going to buy back the puts because we're going to gap up. The puts that I sold are going to expire worthless. So let's do this, create a closing order. And there's that. 0.05, enter. Now, the difference here is that unlike the other side where I was looking at selling those puts, okay? So remember on the ones that are gapping down, I'm looking at selling those puts and being a little naked there. It's the opposite in this case if it's gapping up. If it's gapping up, I'm actually looking at opportunities to buy back the short side of the call, eat that, and then see if this long call can continue moving higher. Okay, so remember in both instances, what are we looking for? Kind of a flat open and then higher prices. Also keep in mind, if we remember Amazon, let's go back and look at Amazon earnings. What time is it? It's 8:20, so I got 10 minutes still. So when Amazon gapped up, this is fairly typical, and this doesn't look like much of a move, but this was like a 10-point move. I mean, here we were at 351, where it opened, and then you can see it kind of took a dip here, and the low of that dip was 340. So it was actually an 11-point move to the downside before it geared up, and that's also fairly common here too. So when we gap up, what I want to do is buy back the puts for sure, and then just kind of be on the lookout that it could start selling off. It's honestly a little easier to manage on the downside moves when it gaps up. What you're not really what you're looking at as a potential is that it's just going to keep rallying again. So it's going to be a little trickier on those, but I'm going to try to record this as best I can. And then the one that's going to be the most interesting is going to be LinkedIn, because on this one I actually thought LinkedIn was going to have a move within the expected move. and it obviously is not. So I actually did a strangle on it too, where I sold the 240 call and then sold the 235 put. So obviously, again, small size, obviously this will go worthless, but at 264, this thing's going to go to $25, right? So that the gain here is going to get offset by a loss here. And then I've got similar situations here. So on this, I'm going to do the same thing. I'm going to place an order to buy the puts at a nickel, take that off, and then see if LinkedIn can have an initial pullback where I can buy back my short calls, okay, and then kind of like on Amazon, and then if it can base out, then my long calls could then appreciate. So obviously there's a lot of moving parts here, but I just kind of want to show you how I'm going to manage this and try to salvage it. And then ultimately, the nice thing with earnings plays like this is, especially on the gap ups, especially on LinkedIn, one of the easy ways to kind of alleviate any earnings pain here is I can sell like a 10 contract put credit spread, and that, if it works and it has a high probability of working, would essentially counteract any losses that I take here. So the good news is when you do these things with small size like this, then you still have actually a decent chance of making money because most of the stocks actually stay within their expected moves. Of course, this one, all 5 of them are at or exceeding it, which will make it interesting. But then for stocks that do move above the expected move, there's some high probability plays to be had, as we've seen in Amazon and Netflix and Apple even this year. And that's a new trade that can be used to not only alleviate any losses here, but also become a new trade. So you might ask, it's like, well, John, why even play earnings? Why not just wait till after the fact? The nice thing is there are a lot of duds where if you do this, and again, it's a low risk to reward, you just sit there and capture that premium decay. And the key with that is you've just got to position size correctly so it doesn't keep you up at night. I went to bed last night knowing that all of these trades were going to be at or outside the expected move, but I slept like a baby because I positioned size correctly, all right? There's the old joke like, oh yeah, I slept like a baby. I would sleep for 2 hours, wake up, cry, go back to sleep. Just kidding. All right, so the first thing I want to do here is I do want to buy back the puts, right? So let's come in here and buy back those. So the 237.5 put at 220, we can buy that one back for a nickel. And again, this just affords a nice, easy cleanup right at the open. And in case, LinkedIn like crashes, I mean, there's no downside to taking that off, right? I mean, there's only downside in not taking that off. And then in the strangle, the 235 put, 885. And let's buy that back for a nickel. Okay, so now I've got all my orders in place, and the market will open in about 5 minutes, and let's see what this sucker's going to do. Okay, so now the markets are open, and you can see now this is showing the P&L during the day. Now some of this it's a little skewed because I've been buying back the short side here of GoPro, Netflix, Twitter, puts and things like that there, and it doesn't show those open profits. So this is showing what's remaining. And then I can go in and start to manage it. And it looks like all of the open orders then are done except for LinkedIn. So LinkedIn is still setting up here. Okay. There we go. Just heard another one, Phil. Oh, there we go. Expedia. So at this point, I'm just kind of, now again, this is where you want to keep an eye on your net liquidating value. Even though this is showing that it's down $5,000, it's actually, I think the net lick is down about $2,000 because once you start bringing in the short side and bringing in those profits, of course, it's only showing the remaining trades that are taking heat. So, all right, so now I need to work on LinkedIn here. So this is going to be interesting because I'm just trying to do this. It's a little clunky trying to fit everything into one screen. All right, so you can see here that the 41 put, that's $1,100 in profits. So the open P&L is $1,565. Okay. Or that's the remaining is $397. But anyway, we'll go through all that. But let me get over to LinkedIn here because LinkedIn I need to take some action on. So the main thing that I need to do here on LinkedIn, so yes, I've got a strangle on, and that could be kind of scary in this situation, but you can see that ultimately, you know, with one contract, it's not a huge thing, right? So I don't know. Oh, it's interesting. So those actually, I do have orders in to buy those back at a nickel, but they're not trading at a nickel yet. So that's kind of interesting. So I'm going to keep those orders in. The question though is, what do I do with the rest of this stuff? So now I just kind of need to take a look here for a few minutes and see how these stocks are going to act. The ones that are gapping up are the trickiest ones because they typically will fall, and that'll be an opportunity to buy back the short calls, leave the long calls, and then see if the long calls can appreciate. You know, so we're, you know, kind of a little bit of playing. So, you know, the idea would be, it's like, all right, it comes down, flushes people out, buy back the short call, and then leave the long call for a potential rally. Okay, now this one's just kind of going. The other thing, of course, that I want to look at doing is selling put spreads for the likely continuation of these moves. Okay, so then let's look at the ones that are going lower. So we've got GoPro, and then we've got Yelp. Okay, so, and then this is Expedia. Let me move Expedia over. So Yelp here is kind of gapped down and is still going. My losses at this point are locked in. They're limited. And the question is there any way to salvage that? And so I can come over here and say, all right, let's look at Yelp, because on the downside here, you know, I've got this spread. And one of the things that I'd like to do here is actually sell this long put. Okay, that long put's got some nice profit in it, with my gamble being that this is going to bottom out. Okay, so that's what I'm going to do. So let's create a closing order, and I'm going to sell that 51 put for 460. It's got a natural midpoint there. Let's see if I can get that midpoint. I'm going to go $5. And it might be a, and did I get it? Nope. All right, so here's, you can see it's rallying here. We're at 46.50. And, you know, at $4.77. Oh, man, I might have missed it. Come on now, come on. I'm getting filled on, what am I getting? Oh, I'm getting filled on LinkedIn. Darn, I'm not fast enough here, I don't think. All right, so, let me see. It's trading right there. Darn it, okay. So let me come in here. I'm going to change this order. Cancel, replace order. And darn it. That's okay, 450. I just want out, right? So let's get out. Bastards. Okay. So now I've got the short put on, which is 1070, right? And then the long call, which is worthless. So there's nothing to do with the long call. You don't need to do anything with the long call, right? And then to look at an accurate reflection of where I am, I'm looking at the P&L during the day. Okay, this open does not take into account these profits. So this is where I'm in the hole, $730. And then the question is, if Yelp can rally, can my short put here depreciate enough to make up that loss? So that's what I'm doing, okay? Of course, the danger here is what? That this thing just keeps going lower. But my position size is small enough that I don't need to freak out about it too bad. So I'm going to do the same thing here on GoPro. Where we're at 47.30 and you got a small profit here, not huge, but I'm going to sell those $48 puts. They're $1.30 midpoint. Let's go for $1.40. Okay, so now the game is on where I'm betting on a rally now. Okay, I'm betting on a rally to see if I can actually turn this into a profitable trade. Right now it's down $300. Okay, so it needs to rally. And then what was the other one? Expedia. Okay, so I'm going to do the same thing here in Expedia. I'm going to sell that long put. The $82 put, which is got a decent profit. You know, it's keeping my PN. So again, I'm not having, you know, this isn't horrible, but I'm trying to finagle it here. And I want to sell these 82 puts at $265. I'm sure the bid ask here is horrible. Let's try $3. See if it'll fill me. Nope. You got to be quick because these, when they start to go, they just really start to go. And I'm just, I'm not trying to get the best price. I'm just trying to, it's a bonus. Anything I can get for it is a bonus. There. Okay. So now, I'm down $682 on this position. So now on all three of these positions, I'm making a bet that we're just going to, get some short covering. And I'm only looking for like $1 or $2. It doesn't have to be a lot, right? Okay, so I'm going to move these over to the side now. And then let's look at the longs. So for LinkedIn, I haven't done anything else on LinkedIn except buy back those puts. I would like to sell some put spreads here, but I'm looking for, kind of like what we saw on Amazon, is to see if we can get some selling. Okay, just people, and that's very common. The market makers are like, oh, good earnings, let the suckers buy it at the open, and then we rip it down. Okay, so if that's what's going to happen, and of course I don't know for sure if that's what's going to happen, but if that is what is going to happen, we want to have a strategy for it. So, all right, so what do I got here? So what I'm looking at doing is that if we can fall, and let's say we could fall to 255, just kind of a pullback, then I could buy back this short call, not for a profit, but instead of buying it back for $23, buy it back for like $17, right? And kind of reduce the pain there. And then also buy back this 237.5 call and do the same thing and just buy it back for less than that. Okay, that helps fix, helps repair that. And then at that point, I could leave the 260 call on long with the idea that if this sucker can really take off, it could appreciate. Okay, and then on top of all this, I can sell a put credit spread to take advantage of rising prices. Okay, so if we come back here, there's Twitter. Do the same thing in Twitter, of course. So here's LinkedIn. Okay, so LinkedIn's starting to come down a little bit. Twitter's actually holding up really well. And Twitter's actually holding up remarkably well, to the point where I'm actually ready to sell a put spread on it. But let's look at Twitter here. I mean, that kind of push is pretty solid. So on this one, the long call I could leave on, but more interestingly would be, you've still got good implied volatility here, would be looking at something like the $45 puts. Wow, those are pretty cheap. The at-the-money puts here, and selling some of those with the idea that it's going to hold these prices, and then that premium would evaporate, and then you kind of get your money back, so to speak. But I always like to see, like in the first, it's only been the first 10 minutes or so, give it a little bit of time, because it takes a little bit. You need to get like get at least one 15-minute bar, and then you can, so what time is it? Okay, so we're going to get one 15-minute bar, and then once we have that 15-minute bar, which is this bar right here, once we have that 15-minute bar, then we can mark the highs and the lows of that bar. So right now, like, that's the high, and I'm just going to make this a different color so that we know what's going on here. And then, oh, it went off screen, bastards. Let's see. And then so far, this is the low, right? So all I'm doing is marking the high and the low, and then essentially whichever way breaks first wins. Okay, so if we break through the lows, once that 15-minute bar is done, we'll typically are going to have a pretty decent sell-off, and believe it or not, the expected move can act as support, and vice versa. So that's what I'm doing here. So at this point, I'm going to pause this video for a little bit, because now this is getting kind of long, and we'll see how things pan out. All right, so I'm starting to look at Twitter and LinkedIn. So Twitter has got a big fire line right here. It's actually a good target even for today or early next week. And then LinkedIn, wow, it's already pushing through its tree line. That's pretty bullish. That opens up 274. So on both of these are both actually acting really well. And while my upside right now is capped, like I can't lose any more money to the upside, I would like to try to get a little bit of this back. So I'm going to sell, let me see here. If I sold 5 of those, that would be $410. What I'm trying to do is sell enough to offset. And of course, you could do this as a spread as well. So sell there. Okay. Now, so at this point, I'm looking for this to continue going higher. So I might as well take the cap off and buy back the short call. Okay. So the calls are 585. Oh, now come on, fill me. Darn it. There we go. Okay, so what I've done is I've just made a bet that Twitter is going to go higher. Okay, so I bought back my short call, which was just essentially capping my loss, right? But the danger is now is that if this falls, if Twitter starts to decline, I'm gonna have to scramble. So I just essentially turned my iron fly into a long bet. I don't need to do anything with the puts, the long puts. That's there. But what I'm looking at here for Twitter now is a situation where we could go up to the $48 level, and at that point, that'd be a good place to take profits if we can get there. Okay. All right. That's LinkedIn. Now, obviously, I'm gonna have to keep an eye on things if this doesn't work. And then for LinkedIn here, let's drop this to like a 5-minute chart. Boy, it's a really, really strong uptrend, and I'm just going to make the same bet. So what I want to do here, now this is a bigger stock, so I'm not so inclined to do a naked put, and that's why I went naked with the other one. So let's try let me hide these positions here so I can see this. I mean, we could go out to next week too, but what I'm taking advantage of is a super high implied volatility. So I want to do and this of course becomes a 1-to-1 risk reward ratio, right? So sell vertical, the 265, 260, $1.60 credit. Let's see if I can get filled on it. And it sounds like I did, and I did. So if that turns into a profitable trade, it'll offset that. And then also what I can do here is, again, kind of take this off, take the lid off here, and buy back that short call. And boy, look at that spread. But that's at this point, it's not, beggars can't be choosers. Let's try 28.15. See if that'll go, and that'll go. So just like LinkedIn, what I've done is just took the cap off. And I bought back the short call and sold a put spread with the idea that if LinkedIn can continue to rally here, or at least trade sideways, then this can turn into a profitable trade. The danger being, again, is what happens if LinkedIn just kind of pukes it up here. So that's what I got to look for. All right. All right. So if we check in with these, so LinkedIn, so that's its 15-minute high right there. Let me move that in. So you got the 15-minute high and the 15-minute low. That's been now marked. Ideally, what happens here is we just kind of chop around and then eventually break out to the upside. Twitter, you can see, is just taking off. Let's see, for Twitter, in looking at this, by kind of taking the cap off, so to speak. So we got that long $46 call and sold some puts. So we're kind of starting to make some money on this and turn it into a profitable trade, assuming that Twitter can continue going higher, right? And LinkedIn looks good, but we're kind of in that kind of chop phase here right now. And I want to do the same thing, and we got that put spread going on LinkedIn. All right, so LinkedIn here, I mean, essentially that's the 15-minute high, and that's the 15-minute low, right? That's an extra line. So now that we're through the 15-minute highs, we should be cleared to run. And Twitter, has that fire line at 48. So now let's take a look here. So now Twitter is almost back to a break-even trade. Okay. LinkedIn here is almost back to a break-even trade. It was down like $2,000 or so. And GoPro is now a profitable trade. So and we haven't actually added any more trades on this, right? So, that $54 call. So that was the short call. We bought that back, made some money there. That $48 put, we sold it, made some cash there. And then, of course, the long call is expiring worthless. The only way this trade is going to be profitable is if it rallies and this short put that we sold continues to lose value. So we could buy it back now for a profit. Okay, so, and if we look at GoPro here, so the idea with this is that you can kind of, all is not lost, so to speak. So we just kind of, tweaked it out a little bit. Now, I could, even sell a put spread here, but I don't. With the down moves like this, it's not as clear to me. It's just the moves can be a little goofy. It's usually like a short spurt. Like, I'm not expecting this to have a big rally. If it does, great. But what I'm looking for is kind of a short spurt where I can buy back that short call. LinkedIn X, great. The danger here for me is that it just pukes, of course. So I want to keep an eye on that. Twitter X, great. Yelp does not act great. So so the good news here though is that it's just trading sideways. It's not like it's collapsing, and that's typically true and how it works. So with Yelp here, I'm losing money. I have exposure because I've got this short put, and that's the thing I've got to make a decision on. Unlike GoPro, it's not rallying; it's continuing to bleed lower. But it's not like this huge ordeal. But I gotta at some point. Usually, if it's gonna rally, it's gonna happen like right away. So that's what GoPro is doing here, and that's fine. That's what I want to see. The fact that Yelp isn't doing it, then pretty soon I may just have to cut it loose. And then Expedia here is just trading sideways. So it gapped down, and now it's just trading sideways. And at some point, if we can get some short covering, great. Okay. So that's kind of what's going on there. I don't know. I don't think there's really much else to show today. The idea is just kind of trying to manage this trade. And really, the biggest thing I want to see is that Twitter continues to rally. GoPro, that's great if it rallies. And then the big one here would be LinkedIn. And if that could actually kind of take off here and rally another 3 or 4 or 5 points today, that'd be great. And I've just got to be careful in case it rolls over. All right. So hopefully that was helpful. I can do some recap later on kind of how everything ended up, but that's what we got cooking this morning. So for those of you that are newer and you aren't familiar with what the waves are or how they work, we're going to do a free webinar, or I'm going to do a free webinar on Tuesday, February 10th. That'll be at 8 o'clock East Coast time at night, which of course is 7 p.m. Central. All right. And here, if you go to simpleroptions.com/ABC webinar, it'll take you to this registration page. And in this free webinar, I'll talk about why the ABC waves are my favorite indicators to use. And you can actually use them as a standalone indicator, and I'll show you a play that I like to do. It's called the rolling waves, okay, and we'll talk about that. But I also love using them with the squeeze. It just makes things so much easier, especially in terms of consistency. The best way to figure out which way the squeeze will fire off in advance so you can sneak in, that's always a plus. How to easily determine the short, medium, and long-term momentum for any market at a glance, and then how to filter for it. How to never be on the wrong side of a trend again, because there's nothing more frustrating than that. And of course, how to kind of play the ebbs and flows of the market, plus some other stuff that I'll show you. So again, free webinar, first name, email address, and we will see you there on Tuesday. Have a great weekend.